Welcome back for another WSQ. Today we're going to be looking at the Great Depression. The central question that we're going to be looking at in this video is how did the U.S. government respond to mass unemployment and social upheavals caused by the stock market crash? Once the stock market crashed, we really entered into the Great Depression. Spartan historians will analyze how patterns of exchange, markets, and private enterprise have developed and analyze the ways that governments have responded to economic issues, and then explain how different beliefs about the federal government's role in U.S. social and economic life have affected political debates and policies. As you watch the video, make sure that you answer the guided questions provided. You may need to pause or rewatch the video in order to answer the guided question. When the video ends, go ahead and summarize the main points of the video in paragraph form. Make sure that while you're watching, you use the specific vocabulary given to you on your WSQ sheet. These are going to appear as bolded and underlined words during the video. And then finish by asking one question. This can be something you're still confused about, a general question, or a discussion question for the class. The Roaring Twenties was the period leading up to the Great Depression. So putting this in the historical context, the Roaring Twenties was a time of really impressive and sustained growth. Our gross domestic product rose by about 30%, which was unprecedented growth. American industry had also been growing, especially because of the automobile. With the introduction of the automobile, the steel industry, the glass industry, the rubber industry, all these other industries also expanded, and that helped to expand the American economy. Unemployment was really, really low during the 1920s. It was about 3%. The United States generally fluctuates at about a 5% unemployment rate. The welfare capitalism that had been introduced by Henry Ford helped to increase workers' sense of prosperity and well-being because they were now being paid enough to afford some of the other products. Regular Americans also began to invest in the stock market, and many of them are going to start buying stock as well as other consumer goods using credit, meaning that they didn't have enough money to buy it, but they bought it and they would pay it back over time. The stock market growth had really demonstrated the greatness of American business during the 1920s. Hardy and Coolidge, who had been presidents during the 1920s, passed laws that limited government interference in business and essentially followed a policy of laissez-faire economics. One of the major weaknesses of the American economy, though, was that the economy was vastly uneven distribution of wealth, meaning that the rich were really, 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 really rich, and the poor were really, really, really poor. Americans bought many of their consumer goods as well as their stock on credit, and by the end of the decade, a lot of people had reached the end of the credit, meaning that they had no more money that they could borrow. So the economic factors plus financial factors is what eventually led to the stock market. This poor distribution of wealth, the rich being really rich and the poor being really poor, a reliance on credit. People were only buying goods that they could buy on credit. They were buying all things on credit. Consumer spending dropped because as they ran out of credit, they stopped spending as much. And then also industry started to struggle because of the fact that they couldn't spend as much money, and workers weren't spending any money, so the businesses made less money, and the less money the businesses made, the less money they could spend on hiring workers. There was also some other major financial problems. The stock market rise in the mid-20s had led to a lot of speculation, a lot of people buying more stocks, and they ended up buying these stocks on credit. And then the stock prices rose to unrealistic levels, leading to people to sell their stocks and try and get out of their stocks before the prices dropped. All of these factors, the economic and the financial factors, ended up leading to the stock market crash. When people bought stock on credit, they called it buying on margin. Because, for example, if I bought a stock for $10,000, but it was a $15,000 stock, I would buy on a margin of $5,000 because I would need $5,000 in order to buy that stock. The brokers who were selling the stock required lower and lower margins for stock purchases, which meant that they started giving bigger and bigger loans. It was really risky for investors because if they didn't have that money, they couldn't buy that, right? You shouldn't buy anything that you don't have the money for. But it's also dangerous for stockbrokers because they were giving money to people who couldn't pay them back. The brokers could eventually force the investors to pay back their loans if the stock's value fell below a certain point, and they called this the margin call. But those people didn't have that money to begin with. The Federal Reserve started getting really concerned at this because they saw this economic crisis before it happened, and they started making it harder for brokers to offer these margin loans. But the corporations, those big businesses of people who were buying those stocks from, they wanted people to continue to buy stocks because the more people bought stocks, the more impressive their business would be, and the more money that they would eventually make. And so they continued to give cash to brokers to sell to people. On Thursday, October 24th, the investors started selling their shares. They were really worried that that their share would plummet, and so the bankers came together and they started buying the majority of the stocks, trying to prevent the decline from happening. The stock market officially crashes on Tuesday, October 29th. They call it Black Tuesday because it crashed like that. The effect of the crash had on individuals is that those investors who had bought stock on margin were in a lot of debt. So there was a lot of Americans who were in a lot more debt than they could feasibly pay off. The stock market crash also triggered a banking crisis because people that were paying off their loans, they ran to the banks to get their money out. These banks were then out of money, and so they had given loans also to the stockbrokers to sell stocks on margin to the investors, and so they didn't have any money to give to anybody. And so a lot of these banks were in debt. With the money being scarce, investors are unable to provide businesses with loans. And so they're unable to give these businesses the loans they need in order to help the industry grow. Consumers also started spending less money because they had less money to be able to spend. Their credit was at the very, very end. And so as these companies started making less money, they also had to start firing workers. American banks also had loaned a lot of money to European businesses and governments to help them after World War I, and now they want this money back. The European businesses, however, don't have the money to pay them back, and so the United States and other foreign governments start passing high tariffs, trying to protect their own businesses and making their goods more expensive, and protecting their businesses here in the United States, but they're unable to do that. And it ends up hurting everybody overall. President Hoover is the president at the start of the Great Depression. He favored a limited role in government. This had been really successful in the 1920s. He really believed that, and this idea called rugged individualism, or this idea that people should work hard for their money and take responsibility of themselves. He also believed that businesses should start to form voluntary associations with the government, and that would make the economy more fair. He called conferences with business, trying to figure out ways that the government and the businesses could work together. The creation of the Hoover Dam is an example of an associative state or a voluntary association. Hoover believed that the government really shouldn't be giving people direct aid, but they should give people opportunities to help themselves. He really felt like he should give the businesses more money, because then the businesses would be able to turn that money into jobs for other people. He pushed for a set of loans to strengthen cooperatives for farmers, because farmers were really, really poor during this time, and that they needed to be able to buy the materials and needed to sell their food at low prices. Hoover continues this practice after the stock market crash, and he tries to tell businesses not to fire a lot of people, but businesses are not really going to be able to cooperate. Although he was against direct aid, he did offer to give money directly to businesses in the form of a government loan. The Reconstruction Finance Corporation authorized $2 billion to banks and insurance companies and businesses that potentially were struggling because of the Great Depression. In 1930, he signed the Smoot-Hawley tariff that would raise the cost of imported goods, trying to make American goods more attractive to Americans. But European nations also responded with high tariffs, and that limited international trade, and Europeans weren't really buying American goods. Voters were really angry with Hoover because of this. He was really optimistic, saying that things are going to get better, things are going to get better. And so this ends up leading to Franklin Roosevelt becoming president in 1932, because he's not going to be able to win back all the voters that he previously had. In addition to that, Congress refused to approve a payment for a group of veterans from World War I, and these veterans called themselves the Bonus Army. They were met with violence in Washington, which was looked down upon on Hoover, because he opposed paying the bonus marchers, and he also responded with violence. During the Great Depression, there was a lot of unemployment, and poverty was really affected people's ability to buy food from the already struggling farmers. The prices of farm goods went down even more than they had been before. They were producing more than they could sell, which led to overproduction, and the prices of these farm goods to also decrease. The farmers had borrowed money from the banks to buy farm equipment and land, trying to get more money, but the banks were also going out of debt, and so they demanded this money back from the farmers, and the farmers are unable to pay back their loans. So oftentimes their farms were foreclosed on, and the bank took their property or anything back that they could to pay back the loans that they had taken. Businesses that could no longer sell their consumer products were not making enough profit to keep their workers, and so they had to start firing their workers. Unemployment went all the way up to 25%. African Americans were unemployed at a 50% rate. As you see in the picture on the very far left, I know 3 trades, I speak 3 languages, I fought for 3 years in World War I have 3 children and no work for 3 months, but I only want 1 job. The food line in the middle is the African American food line in the city, and behind them it's a kind of double standard because it says the world's highest standard of living, talking about America, and there's no way like the American way, but yet these people are standing in a food line waiting to be fed. Having a grab in the Great Depression meant that you were really, really lucky because it also meant that but if they became unemployed, you would quickly be poor. There was not a lot of government programs during this time period to provide any sort of welfare. They relied instead on bread lines and soup kitchens. If an American lost their home, which quite a few of them did, they moved into makeshift communities that they called Hoovervilles after President Hoover. Many men became hobos, leaving their families behind, attempting to find work or food on the train lines. A lot of people became ashamed of the poverty that they endured during the Great Depression. Men especially that couldn't support their family were embarrassed. The suicide rates in the early 1930s rose to astronomical levels. Lastly, farmers that were already dealing with debt because of the banks then also were experiencing the Great Depression through the Dust Bowl. Agricultural practices and the peeling away of the ground and the nutrients in the soil had left the soil very, very loose and led to a lot of dust storms. This covered crops, blew into homes. Oklahoma, Kansas, Colorado, New Mexico, and Texas were the hardest hit areas. Farmers in these areas had a really hard time making it work. Many of the farmers that had either been foreclosed on or were affected by the Dust Bowl traveled along Route 66 to California because they knew that the orchards that were there were hiring workers. A lot of these migrants became known as Okies, and it was a derogatory term for those who were moving west in search of work. People in California really resented Okies because they felt like they were taking their jobs. As you watch the video, make sure that you answered the guided questions provided. If you need to pause the video or rewatch it now, make sure that you go back and do that. When the video ends, go ahead and summarize the main points of the video in paragraph form using the specific vocabulary given to you on the WSQ sheet. These appeared as bolded and underlined words during the video. And then don't forget to finish by asking one question, a confusion question, a general question, or a discussion question for the class. Thanks for joining me for the WSQ, and I'll see you in class.